Welcome back, guys. Again, today we're going to be looking over chapter 2, which is what is accounting. So, again, yesterday, if you guys remember, chapter 1, we were talking about the introductions to accounting, which, we got to see what kind of areas there were in accounting, as well as what is accounting. So, here we're going to be diving in a little deeper. So, again, we're looking into what is accounting. Again, it is the recording, sorting, analyzing, and summarizing data from all business transactions. Okay, so again, when we were looking at our areas of accounting, our primary focus will be, again, financial accounting. We're going to be dealing with the private sector. We're dealing with the basic daily transactions and understanding how these transactions affect a business. Okay, so we're going to stay in financials. Again, when we're looking into learning accounting, you have to understand that accounting is a completely new language. So I gave you some examples here. So again, to receive is a receivable, straightforward. If you need to pay somebody, it's an expense. To pay is an expense. To owe somebody is a payable. When you own property, it's considered an asset. And when you have obligations, it's a liability. Okay, so understand that some of these key words will help you interpret a transaction. So what I mean about that is when we go dive into the 7 steps of how to record a transaction, it's trying to understand what is the transaction at hand. What are you doing? Are you paying somebody? Do you owe somebody? If you do, that is how you're going to be able to understand, analyze the transaction, and be able to sort them in their correct account types or categories. Okay. So again, here is the slide here. So what is an account? An account is a system to keep track of records and to keep them organized by sorting them into either assets, liabilities, equity, revenues, and expenses. So again, these are the 5 types of accounts that you will see, and I will go through every single one. So here is a little thing that you will need to know, but not right now. Understanding that the difference between permanent accounts and closed accounts. So when we move on to the closing process, our revenues and our expenses will close, because some of the reason why we close them is because these are transactions that may or may not occur the next month. So for you to close them out gives you basically a clean slate to go ahead and continue doing your regular business, because every month your business or your expenses to operate the business, they're never going to be the same unless you have a reoccurring one, which is something like rent expense, right? Something that's going to happen every single month. And yes, we normally close them out because sometimes this month we might have advertising expense. Next month we might not need advertising anymore. So it's good to close them out. Again, we'll talk more about that when we move on to further down in accounting. I just wanted you to recognize there are 5 categories, 5 types of accounts, and they are the asset, liabilities, and equity, and you have your revenues and your expenses. Okay, so I'm going to go ahead and explain this because this is kind of an easy / kind of difficult concept to understand, because there's a million ways of looking at it. So when we're looking at our accounts, right, we would need to have like a bunch of titles, right? So understanding what a main account is, it's kind of like the umbrella. It's like a broad term, like everything that falls under assets, it's a main account. Or for example, I have equipment, but I want equipment to be the main account. And in order to expand what types of equipments or what other equipments we have under equipment, that's where you're going to utilize a sub account. All right. So in this case, I made an example here. Cash is a main account. Accounts receivable is a main account. Now, what's under accounts receivable is a contra account. So a contra account, what happens with a contra account is it's let me explain how the direction of a main account works actually first. So when we're looking at a main account, it's going to flow in one direction. So for example, when we're looking at a main account, it's increasing a certain way. It's going to be increased by a debit, and I'll explain what that means in a minute. When you're dealing with a main account, it's going to increase in one direction. Your sub account is going to also increase in the same direction. Your contra account is going to flow in the opposite direction. All right. So again, for example, if my accounts receivable is flowing and in the debits, and it's increased by a debit, the opposite of that, which is the contra account, is going to be a credit. So understanding the flow of how debits and credits work, all right? So I just wanted to know that there are different types of main accounts and sub accounts, and we have a contra account. And I just wanted to make sure you guys understand that. Is that clear, or is there something you want me to clarify for that?
I don't think I had heard of contra accounts before, but I understand what you're saying.
Okay. Yes, so if we don't have a place, so when we organize our accounts, right, we want to make them so that each transaction has a location to, insert your debits or credits. So if, for example, since accounts receivable, if you can't collect that money, you can't consider that money as something that you're still collecting. It might be written off as a bad debt. Now, if it's written off because that person's never going to pay you back, you want to be able to separate that, so that this a group of people or this amount of money is not going to be collected. So how you do that is you're going to create a contra account, which kind of, you'd be able to transfer the remaining money in there. So it would decrease the...
Is that considered a bad debt?
In this case, yes. Yes.
Okay.
Lynn?
Mm-hmm.
Lynn?
Mm-hmm.
Okay. In financial accounting, you cannot claim bad debt, okay, per se. What you're going to use is a contra account called allowance for doubtful accounts, which automatically decreases the value of your receivables. Bad debt is reserved, because for tax purposes anyway, bad debt's reserved for people they've either gone bankrupt or you went through all the legal hoops to try to collect and have not been able to collect.
Mm-hmm.
That's going to take several weeks, if not months, down the road to claim bad debt. Whereas the allowance for doubtful accounts, once I tell you, hey, Andrea, right?
Yes. Uh-huh.
Okay, Andrea, I can't pay you. I cannot pay you. I got cash, or I don't like the way you did it. I don't want to pay you. Okay. Right now, your job is to put that into a contra account because it's no longer a viable receivable. Your receivables department, not you, your receivables department is going to try and continue to collect on that account.
Okay.
Once they've exhausted all their um, attempts, then the tax accountant, not you, the tax accountant will claim it as a bad debt for the taxes.
Okay.
Okay. Right now, you're only a financial, and you're going to record this what's happening now.
Okay.
Right.
Okay.
So
Thanks,
yes,
yeah.
there is a section in this financial accounting that we will be learning that. I believe it's going to be chapter like 8 or 9. I can't remember because I changed the chapters. But yes, we will be looking into what an allowance for doubtful accounts is and what the difference between that and a bad debt is. So again, I just wanted to show you an example of how we're categorizing our accounts. Okay, now you can do significant like gestures where I'm going to capitalize all my main accounts and I'm going to make my sub accounts lowercase. Now, whatever helps you visualize that this is the main account and this is a sub account, and obviously a contra account will be like either indented or something like that. Now, you can do whatever you want. Just remember that when we start looking to the chart of accounts, every account that if you do utilize a chart of accounts, you can do a serial number or you could do what do you call it, a account, like mixtures of numbers and letters just to indicate each account. So this is one way you can organize it, but also you can also utilize just account numbers in general, and it should be able to function the same way. All right. So yeah, that's just an example of when we're looking in. So again, cash is a main account, accounts receivable is a main account. So for example, here inventory, right? Inventory is the main account, right? It's such a broad, it's a broad category, or it's a broad term, right? But if you want to be more specific, like what kind of inventory do you have? That's when we go down to the bottom and create a sub account. So the sub account gives the main account more detail. All right. So again, I have coffee mugs as part of my inventory. All right. So yes. Now here's the great thing. This is the easiest one. Debits and credits, just understand it as left and right. Okay? All right? You hear debit, left. You hear credit, right. Okay? And when we move on to the journal itself, it's pretty self explanatory. The debits is going to be on the left side, and the credits is going to be on the right side. So, understanding this concept. Now, do not confuse debits and credits as increase and decrease, okay? Because when we look at a transaction or looking at the flow of how debits and credits work, depending on what type of account you're dealing with, you will be dealing with a credit increasing an account while a debit decreases an account. And then and vice versa, you'll be also dealing with debits that increase an account and a credit that decreases an account. So again, never refer debits as credits increase and decrease. It just depends on the flow of transaction. But one for sure is debits is left, credits is right. All right.
And I need aspirin.
Okay. So obviously we're going to be looking at the accounting equation. It's going to be your assets. It's going to equal your total liabilities and equity. All right. So again, this equation must hold true. Whatever you're dealing with, whatever transaction you do, your assets must equal your liabilities plus your equity. If for any reason you have one that's bigger than the other, you did something wrong. Your accounting is wrong because this must hold true. They must equal each other, or they must, if or in other cases, the way if you're looking at it, they have to equal zero. They have to equal zero. All right. So when we dive into actually going into more stuff, this will get more and more. What do you call it? It will make more sense. So now dealing with each account type. So again, assets, liabilities, and equity. So the first one is, what is an asset in the first place? Assets are anything that you own. That's it. Anything that you own is considered an asset. Property, rights, anything that you own or anything that's like a physical or intangible, whatever it is, as long as you purchased it and it's your property, it's considered an asset. All right. And assets are broken down into three categories. We have a current asset, we have fixed asset, and we have other assets. Now, how they are categorized is very important to understand too, because this one is going to be based off of how readily available, or what we call, liquidity. So how easy is it for you to convert it into cash? So current assets are usually the top that you would see would most likely be your cash, okay? Accounts receivable is people owing you the money. So you can convert that easily by going up to them and claiming the money. Again, inventory, you can create cash by just selling your inventory. So it's going to be based upon how quickly you can convert it to cash. Now when we look into fixed assets, another key component for a fixed asset is it has a life, or a life longevity to it. They last usually more than a year. All right. Now, fixed assets is also known as property, plant, and equipment. PP&E. If you just understand fixed asset as PP&E, it's pretty straightforward. If you have property, so it's like land, a building, that's considered property. If you have a plant, plant is actually building, sorry. If we own property like land, a parking lot, acres of something, right? That's property. Plant is any facility, a building, a warehouse, right? If you own that, that's considered a plant. And then lastly, equipment, straightforward. Any machinery that does for the business, even a printer is considered equipment. That's considered, equipment. And what happens is that when you buy it, it's not easy to sell, especially if you buy it and these objects, right? When you buy it, what usually happens? It gets used. It depreciates. Thank you. It depreciates. It loses its value. So, of course, just because you bought it and you never opened it out of the box, you automatically lose the value just because you've touched it. Okay? Just as, weird as that sounds, but that is very true, right? Same thing with a car. You drive it off the parking lot, you automatically depreciate $2,000 right off the bat. So again, it's more difficult to sell because no one's not going to want something that you opened. You know what I mean? It makes sense. So it's going to be harder to sell and harder to convert to cash. So that's that right there. All right. And then lastly, other assets. Now, other assets can be, either intangible goods or things that are like maybe you have some deposits that you have or prepaid accounts. If you made a payment ahead of time, therefore, it's something that you own that another person owes, right? So again, other assets can be anything, so miscellaneous. Most common other assets are intangibles, so things that you can't really touch, and they have like some kind of either legal obligation or some kind of legal right. So commonly you would see would be patents, copyrights, things like that. So that will all fall under the category of other assets. It's also pretty straightforward. If you don't have a clue where an asset would fall under, you can always shove it into other assets, because if it's not a property, plant, or equipment, and it's not something that's easily convertible in cash, you could go ahead and throw it under other assets. Okay? Any questions about assets? All right. So next next category, next account that we're going to be looking to is going to be liabilities. Now, simple, straightforward is liabilities is not debt, but it's an obligation. So make sure that you understand the difference. It's not debt that you created, it's obligations that you have to pay in the future. Okay? So when we're looking at liabilities, right? We owe someone something. That is what a liability is. Straightforward. We owe people something. Okay, whether it's a good, service, or even money, we owe. That's the bottom line. And it is there's two categories for liabilities, and that's current and long term. Now this one's a little different. It's not going to be based on how quick it can be converted to cash. This one is going to be based on how long how long you owe. Okay, so typically most current most current liabilities usually have a lifespan of less than less than a year, so less than 12 months. So obviously, if you are making purchases from somebody, you have usually 30 days. That is something that you are obligated to pay, in a short amount of time. Long term, right? So is anything over a year. So typically, what you would normally see would be loans. Things for if you have a house loan, your loan is for 36 years, or more, or less. I don't know, but typically it's 36 years if you get a house loan. So these are obligations that are going to take you years to pay off. All right. So here I have some examples. So accounts payable is basically our way of saying this is the money that other people owe us. This is money that we owe other people. So we created an account with other vendors and we owe them money. Okay? Notes payable. Now, notes payable is a tricky one. Notes payable is pretty much like an IOU. It's where there's no contract involved. It's just saying, hey, I promise to pay you back in 5 months, right? This one, you have a little leeway because with notes payable, you can extend the time. That's one key, That's one key thing that why notes payable can be a tricky one. It can be both either a current or a long-term asset. Liability. So, and then sales tax payable. Obviously, if you're collecting tax from other people for making sales, you can guarantee you have to pay at least within the year. Long term, again, are loans. All right. Any questions about liabilities?
No.
All right. Next, we're going to be looking into equity. Okay. Now, this is definitely something that you need to pay attention to because you will be asked, what are the categories for equity? And right here, equity has absolutely no categories. All right? But in here, I've given you a couple of things that you would see normally that affect how equity is. First, I'm going to start off. What is equity? Equity is basically the value of your company. Okay, it's a lot of people see it as what did you originally invest in your company, right? In order to increase it, it's either you put more of your own money into it, and it will increase the value. But if you take away money, which is a withdrawal, then you're losing the value of the company. Now, again, when we close out our books, we have two options. If you do make a net income or a net profit, you can pocket that profit, and it's your money, right? Because you've earned it. This is what you've earned. Now, what a lot of people do is they take that profit and they reinvest it back into the company. So they're going to raise the value of the company. So again, equity is just the value of the company. And things that affect it would be capital contributions, which is you investing your own money. Withdrawals is going to decrease the value of your equity. Now, again, what is the direct influence or the direct things that allows it to increase and decrease would be income. All right. Now, typically, income will be your revenues minus your expenses, but again, it is not equity does not equal revenues minus expenses. It's just a part. This is what influences them. Okay. So next thing that we're going to be looking into is income. Now, income or revenues, they mean the same thing. You can use them interchangeably. So if you call this revenue and I call it income, we're talking about the same thing, right? So again, on your exam or whatever it is that you say, and you want to say, I wrote revenues, it's correct. All right. Now, what is income or revenues, right? It's pretty much what is your business's goal of creating income, right? What is your main operations that allows you to produce income, right? And because we're dealing with a merchandising company, we're going to be obviously looking at sales. All right. Sales is our primary operating revenue. Okay. Now there are some categories for income. Primary one that you will often see will be operating income and other income. Now, when we move on to more advanced, you'll also be introduced to non-operating income. So, if you're having to pay for labor, that's considered non-operating income, all right? Or if, let's say, you own stocks from another company and you're applying it to this company, that's considered non-operating income because it's not the core of your business, but it is a type of income that you're applying to the business. Again, you're not required to know that. All you're required to know is operating and other. Then when we move on to expenses, right? All expenses are needed in order to have your business run, right? You need to have expenses. So again, there are two categories that you're required to know. It's going to be cost of goods sold and operating expenses. Again, when you go into more advanced level, you will be introduced to a non-operating expenses or other operating expenses. Again, the last category can be interchangeable. I will not require you to know that, but I just want you to know that there is a non-operating expense. And usually this goes for if you have a warehouse that holds your inventory, which is part of your main core of the business. It'd be non-operating because it's not part of you're paying for the facility to have controls, maybe it needs temperature control. You're paying extra expenses that has nothing to do with the core of your business, right? It's non-operating. So again, that's just an example of a non-operating expense. All right. Any questions as far as all of that? All right.
No.
Now we're going to be looking at the accounting model. If I can pull my brain out and remember if this is correct, I believe in your chapter 2 lecture notes, this is page 5. If it's not, it's one of those pages, all right? It's definitely one of those pages because you will see this exact model here. This is how you understand the flow of transactions, right? If you increase your assets, let's say I purchased all these items for me to own, you're going to increase it by your debit, okay? And this is what I was talking about earlier. but let's say you sold your inventory. You need to decrease your inventory. You would decrease it by with the credit. All right? Understanding the flow of transactions is debits and credits, right? The same amount of debits and the same amount of credits is going to equal 0. And this is exactly, it's like when you're counting, if you're going to take 10 steps to the left, how do you get back to 0? You take 10 steps to the right and you're at 0. So this is the same concept. When we're trying to increase our assets, we're going to increase it with a debit, and how we decrease an asset, we would decrease it with a credit. All right? This only applies to assets and expenses. All right? The other types, so liabilities, equity, and revenues, they go in the opposite direction. So instead of being increased by a debit, they are increased by a credit. And how you zero it out or trying to go back to 0, you would decrease the account by a debit. All right? So understanding or just memorizing that debits and credits, right? They increase and decrease both directions. How you look at what kind of account you're dealing with is going to determine which way they flow. All right? So again, assets and expenses are increased by debits and decreased by credits. Liabilities, equity, and revenues are increased with credits and decreased by debits. All right? This will make a lot more sense when we start journalizing our transactions. Okay? Any questions about the accounting model?
I think I need a drink.
All right. We're almost done here, and then we'll take a break. So I'm going to be introducing you the accounting or bookkeeping systems, right? We have 2 of them. We have a single entry, and then we have a double entry. Now, a single entry means it's only one direction. It's only one flow. And I just want to only increase my account. It's only one way, and you're flowing it in one direction. All right. So for example, I write a check, right? I know I'm losing money. That's only one way I'm recording it, right? Where double entry, right, requires you to have 2 directions. It requires you to have first, you write the first direction, which is whatever you want to have, debit or credit. And then you're going to have the equal and opposite of where that credit or debit or credit is going. So you're essentially recording 2 directions, one going in and one going out in the same and equal amount. All right? And again, we'll understand what that is when we start journalizing. So, for example, you have a cash register, right? This is where you're going to record my check of me writing my check out, but I'm also going to record where that check is going, which is I'm paying it to my vendor. Then my equal and opposite credit or whatever it is, debit or credit, is going to be for the same amount. And I recorded it in 2 places. I recorded it in my checkbook, and I recorded it in my check register. My cash register. All right? Again, this will make a lot more sense when we move on to journalizing. All right? Another thing that when doing this and utilizing the double entry, you need to make sure that all debits equal or match all your credits, right? All right? And that is the end of chapter 1. So again, here's a brief little review of exactly what we just talked about, the accounting equation, how the debits and credits flow. understanding the different categories for each type of account, and understanding the difference between temporary and permanent accounts. All right? So that sums up chapter 2.